Folks, again, Jeff Clark here. We'll be getting started here in about a minute. We did add a couple things to this, kind of tweaked it a little bit. I still have some more I could put in here. It's funny when you open this up to discussion with agents, which we love hearing the interaction. I'm going to start just as, I do my own presentations. We have different directors here and trainers that do things, or I really kind of saw a lot of value in doing surveys. We had, I don't know, 60 of you respond to the survey, kind of saying what you'd want to be here for more. So at least for my presentations, I'm going to be looking for some interaction, some ideas, we're even be doing some live interactive surveys during the presentation to kind of pivot. Wasn't quite ready to put that together today, since I'd already surveyed and taken so much good, useful information from people to kind of put some of this together. We'll kind of say that for another presentation, but I do like the interactive nature. I like hearing from the agent base. It's just to like, let me do a longer introduction. We'll get rolling again. Jeff Clark here, Regional Director, GoldenCare USA. I want to thank you guys for coming over. We have a really big class today. I think it's over 70 or 80 people, so a lot bigger than we normally get. So as we're getting a lot of people kind of winding in here, I think there's already 30 or 40, but people are coming in pretty rapidly. So I'm just going to kind of do a slower intro. A little bit about myself. I have been doing long-term care since 1997. Interesting, I was just going through some old files, doing some spring cleaning, and I saw the contract I signed. I think it was November 16th of 1997. So, and I started with long-term care. I didn't know anything else, and so I kind of cut my teeth on that product. And I didn't find out till probably a couple of years later that it was one of the harder products to sell. So I eventually, of course, started selling burials and Medicare supplements and other products you kind of run into when you're on the field. If someone asked me if I sold annuities, I certainly didn't say no. I said yes, and I would go home and I would study up on annuities, and I would come back the next day and pitch them an annuity. But so I've always done long-term care. I've probably written about 800 to 900 long-term care policies, a lot of which are still in the books, amazingly. But about, let's see, in 2001, 2002, about 5-6 years into my selling career, I was promoted to this position as a regional director, more or less training and helping with product design, presentations, selling pieces, kind of helping agents learn products, how to sell products. So I kind of immersed myself with the different products and how to sell them. And so one of the topics that came up with this was objection stoppers. The common objections you get. And I went ahead and did a survey, and I'm going to switch back to that at the end of this here and just kind of somewhat go through some of those questions. And a lot of them are the common objections that I already had put into this thing. And so just taken from my sales experience, take it for what it's worth, talking to many of the top long-term care insurance salesmen all over the country over the past 25 years, I've just gleaned a lot of stuff from them. So that's kind of what I'm sharing. The idea here is to kind of be an open forum. I do, welcome to go ahead and type in some questions, comments, and I'll go ahead and try to address those also at the end. But mainly, I just want you to kind of sit back and I could have done some more stuff, as far as should I invest my premiums that I would be putting a long-term care policy on this. I wanted to put some more numbers together on that, but I'll address that when we get there. So this again is kind of an evolving presentation, but with that, I want to kind of get started. I got a lot of you in here, so again, just thanks a lot for taking a little time with us. I do appreciate that. We appreciate it here at GoldenCare. Hopefully we can help you sell more long-term care. Okay. There it is. All right. So again, a little bit myself. I've been working with GoldenCare for 26 years. Before I've been doing this to lead off all my webinars lately, and I'm going to do this very briefly. But if you aren't talking about COVID, if you aren't aware that the customers out there, the public, the general public, is terrified of facilities, nursing homes, assisted livings, having to go get care somewhere else. And I won't bore you with all these stats, but 61% of people would rather die than go to a nursing home right now. And that's because you are 11 times more likely to die if you receive your care in a facility versus if you are cared for at home. In other words, 37% of these people receiving care at a facility. If you're at a facility, 37% of people got coronavirus and 11% of those people died. So, if you're at home, conversely, only 3% chance of conducting the coronavirus and only 1%. So essentially, you're 11 times more likely to die from coronavirus if you get your care at a facility. The public is keenly aware of this. I promise you, if you go talk to your clients about long-term care, I know it's a hard subject to bring up. It's the reason that people don't, they're not comfortable with the product themselves, or they don't understand it as well, so they don't feel confident selling it. Well, I promise you right now, people are looking for long-term care solutions. They are waiting for agents, and there's really a lack of good agents out there that talk about this product with any confidence. So, use GoldenCare as your confidence. We'll get you anything you need as far as products, proposals, presentations. We'll help you pitch. The biggest thing is go out and talk to people, because they are really more than ever more keenly aware of long-term care, what it means, and how they can help plan their care needs as they start needing them. So COVID has been a hot topic for us. We've never seen the type of lead generation we're getting off our websites, the interest that it's created. So be aware of that and go talk to your clients, for you're doing them a favor. They are terrified and they don't want to go to a nursing home. So, just know that. I don't like to use scare tactics, but right now it's on their mind, and we are the first line of defense of keeping those folks out of facilities. So, okay. All right, objections. I said this last time, but just kind of know that when we go through this, there's no perfect response to every objection. There are good ones and, maybe not so good ones. And, depending on how you pitch it, how you say it, everyone's got their own style. But these are just kind of keep in mind that, these are just merely shared opinions from some of the top long-term care sales people from around the nation. So no one response is always right, but we always welcome more suggestions, thoughts. I gleaned a couple things off the ones that we did gather here. And I did mention we're going to maybe kick out some, maybe an Amazon gift card to some of the people that we did use. I have a couple of those in mind. But also remember here at the bottom, I just added this point that sometimes agents tell me that, long-term care is too hard, or this is too, I get too many objections. Well, it's kind of part of what we do as our job. Handling objections is kind of what, as a salesman, it's kind of what it's all about. So it's just part of the job. Okay. First at the top, the first objection you get, it's usually a smoke objection. It really has no bearing on the buying decision. The prospect is simply just trying to kind of postpone, drag their feet a little bit. Yeah, I know. I do kind of, you know what I'm talking about, where they're just, well, I don't know. I should maybe think about this, or I'm not really sure. Or they're just, all they're doing there is they're just trying to basically delay it a little bit. So one thing, and again, this is something that someone mentioned. Let's call him Ray from Ohio. And this is something that when I first time did, I probably didn't mention this, but what I'm telling you folks here is kind of how to handle the objection. I'm not putting the empathy that I would be normally if I was talking to a consumer. Like, I'm trying to tell you, the agent, this is what I would say in this situation. This is what has worked. So I probably didn't say that well enough, but it is important on any objection to really look them in the eyes and understand that, and recognize it and empathize with them, and really, genuinely look, that's a very good question. That's a lot of people I talked about this, that they had the same concern. And, I'm glad that you asked me that. I think that's important to show some genuine concern on that objection and look like you really do care, that you really do actually understand what they're asking them. So just, repeat it, whatever it's going to be, show some genuine concern and empathy for that objection. It'll help you, look softer. Okay. The four main reasons people don't buy, really, they don't think they need it, they don't understand it, or like it. They're in no hurry, there's no urgency, or they can't afford it. These are kind of the big four reasons that people don't buy anything, not just long-term care. So, and really, as far as do you need it? Do you understand it? Why isn't there any urgency and they can't afford it? These are all things that should be being flushed out if you're using a presentation. So, if you're not using some type of a presentation, you should be. Because those first four things I just mentioned, I have a lot of those eliminated if I'm going through my presentation. These are just two presentations that we have. I want to touch on them. One of them is a missing link. This is our basic presentation that we've used for 20 plus years. I actually used this presentation when I started 25 years ago. It's been continually updated. It's been, new stats put in there, new slides, new ideas as times have changed, but it's a nice track to run on. It's probably 26 slides. It takes about a half hour to go through, but it allows you to hit these hot spots that maybe you as an agent don't think is important, but that client sitting across from you, maybe that was their hot button and you never brought it up. So what a presentation will do for you is just kind of make you aware of all the things that people normally triggers that urgency or that need in them, that one that you might be overlooking. So a presentation just allows you to hit all those things. And again, why not use a proven presentation that sells $1 million of long-term care a week? Even if you don't like all of it, parts of it, or maybe you'll use it. But certainly you should have a track to run on. The other one we have here is this longevity planning, or it's the same thing. It's a presentation for long-term care, but this thing is amazing. This thing will allow you to pivot as you go through. Maybe the person has Parkinson's, and I'm going to show you this in a little bit here, but maybe they tell you that they, they're already having this medication or that, so you can't sell them a traditional. One of the biggest objections that I hear from people why they aren't buying or selling more long-term care is because of the health and underwriting. So these three objections here, a good presentation are going to flush these three out. So I call these, I don't know, I call them pretty clever here. A good presentation should flush out and eliminate these common objections. And these are some of the three biggest ones, and we're going to nip these in the bud: health, price, kids, and extended family. More the first two are really easier to do in a presentation. The second one, I added a little slide here. I'll kind of talk through that. But when I'm starting out with a client, let me just go to this. We talk about the steps of the process. So in other words, I'm going to talk that the first thing, and it should be, otherwise you'll spin your wheels. And if you go in there with a traditional long-term care policy only, and that's all you had to pitch, and you should be finding out if they qualify for it right away. Otherwise, because most people aren't going to qualify. 50% of people that are 60 plus, 70% of people that are over 70 aren't going to qualify. But you should have different products, different plans, different options for them. But I like to sit down with someone and explain the steps of the process. We're going to educate you about the type of protections there are, tell you what longevity planning is, design an affordable plan, start the process. But first of all, we're going to find out what protection you can qualify for. So important, because it is hard to get long-term care. And that's why the consumer is sitting there thinking, I'm not going to qualify for this. I've already got this, that, and there. Agents in their mind, they've already said, oh, this person won't qualify, this person won't qualify. And I guess I'm wondering why that's the case. Because in reality, this is one of the big objections. With my health, I won't qualify. And then a lot of agents are out there thinking, most of my clients are older. There's plans for everyone. I don't care what their health is. So, and this comes out of one of the pivot presentation. But first, remember, relax. Regardless of your health, there's probably a product for you. So unless you're currently living in a nursing home or assisted living facility, and if you're currently unable to perform 2 out of 6 activities of daily living, I'm likely not talking to them, right? If they're already, so if you're not currently living in a nursing home, you're not currently unable to perform 2 out of 6, we can get you some protection. So right away, I want to tell them the first couple slides that you're going to qualify for something here. We've got lots of plans, lots of options for you. So, and I'll come back to the pivot. I think I have that a couple down. Actually, you know what? Right here, I'm going to show you something. Let me back out of this stuff. So this is, and again, if you don't know about this presentation, you're not using it, I wanted to bring this up just to show you. So as I go through this is another one. I know it's not all the way, I'll put it in presentation mode here so you can see it, but this is just some of your beginning, longevity planning. So this is what is long-term care? Here's the facts, agent's role, get you started. Here's all the carriers we work with. We'll find something for you, right? But down here, we start asking steps of the process. Will you qualify? It's the first thing. But here, right, I'm gonna start asking some things. Remember, I got a product of some kind for you, but let me ask you, AIDS, ALS, essential. I'm gonna ask if any of these, in the last 10 years, have you had these? Why am I doing this early on in the presentation? Because if they tell me they've had, I don't know, kidney dialysis, well, then I know that they're not going to be a traditional long-term care plan. So I'm not going to go through and offer them benefits that I can't give them. So if they tell me they've had some of these, I'm going to go over here and go to, so I hit B, I'm going to go to presentation mode. So again, I haven't done this yet, so live. But as I'm looking at this, as I'm going through and asking them these questions, close look, ever in the last 10 years, a close look, memory loss, mild. If I suddenly find out they've had one of these, I go to here and bang, this is gonna go to the product that I need to. In other words, depending on how they answer their health questions early on, this presentation will pivot to whatever plan we're gonna be going. Well, it looks like they have this, then it's gonna be a home care only deal. It's gonna be a true freedom deal. It's gonna be maybe a short-term care instead of a full-blown long-term care plan. So depending on how they answer the questions health-wise, it's gonna pivot and automatically take them to the plans they can buy. So when you're giving a presentation, I don't wanna hear people tell me, I'll never qualify for it, health doesn't work, or the agents, because believe me, this is a big one. They don't think they qualify for it, or agents don't think. This has been taken care of. If you're not using this pivot presentation, you're missing the boat, because that elimination or that objection has been all but eliminated as far as long-term care goes. Okay, so with my health, I won't be approved. That can be taken care of in a presentation, ahead of time. My kids will take care of me. Now, this is something that I used to do. Let's go back into presentation for this one. Okay, no. Okay, my kids will take care of me. This is what I would like to do on this one, and I always did this. First of all, I'm gonna ask them early on, when I sit down with them, maybe even during the warm-up. I'll ask them point blank, do your children should they be here? Do you wanna put them on the speakerphone? Do they make your decisions for you? You know, most people, no, we still make our own decisions. You know, what have I done there? Well, I know now when I get done and I'm asking to kind of move forward, they're not gonna say, well, we gotta discuss it with our kids, right? See, I've already taken care of that. They don't necessarily, but I tell you what I will do in a house, if I get to the point where I'm getting to the end and I want them to maybe send an application in, you know, I do want the kids involved. I want them very involved. So a thing like an Easter weekend coming up, I'd say, you know, why don't we go ahead and start this process? We'll get an application in. You can go ahead and discuss it with your kids. I encourage that. It's your kids that are going to be involved in your care. So knowing that you're applying for coverage, and maybe end up discussing it with them over Easter dinner, and they said, no, we're going to be involved, and you're going to go over these next things with them, and they're going to take care of this. And then maybe you can go ahead, maybe you decide you didn't want to do long-term care. But certainly sending an application in will make you kind of push you towards talking to your family more about this hard issue to talk about. Because when I hear people say, my kids will take care of me, or I hear a kid will call me after I've sold a long-term care plan to a couple, they'll say, how dare you sell that plan to my mom and dad? I love my mom and dad, and I'm gonna take care of them. And that's what I'm hearing them say, is they love their parents. And they almost feel like you've taken that responsibility from, you've labeled them as some deadbeat kids that aren't gonna take care of mom and dad, that I had to come in here and sell them this policy. So what I hear kids saying is they love their mom and dad and they want to do it. Well, but they're not conceptualizing what that means. So I'm not afraid to ask people, and I hit them right over the head, you know. So where do your kids live? Where does your family live? Do they have jobs, families, friends, or hobbies? Because, you know, obviously when they start taking care of you, they won't, a lot of them have to leave their job, you know, they're kids, you know, sorry, friends, hobbies, forget it. So then I'll ask them, are your kids moving in with you? Or are you moving in with them? Are you comfortable with them having them bathe and dress you? You know, I can tell you I took care of my dad for 3.5 years, and I won't go into all the details, but shower time wasn't fun. Not for either one of us. You know, when he couldn't, you know, get himself to get to certain areas, or his, you know, he wasn't very flexible. He had broken his back. He couldn't move certain. So yeah, there's a lot of stuff there that you need to talk with your client. Ask them, have you talked to your kids about, are they going to be bathing you and showering you, dressing you, feeding you? Is this, you know, are you comfortable with them having, you know, them bathe and dress you? Did you also know that when people become caregivers, they're 6 times more likely to suffer from depression? Are you okay with the fact that your care needs, if one of your child's going to do it, is going to cost that child $250,000 or more? Because we talk about not just missed, you know, I always think of people leaving work early or coming into work late because they had to take care of parents. I did that. I missed days of work, taking dad to doctor appointments, or going over to the facility, or when he'd fall off, you know, the toilet, he's trapped in the bathroom floor, I'd have to leave work and go get him. So you can add up all the lost wages, but what you're forgetting is the different hours. And when people do have to maybe leave their job to take care of mom for a while, they're not contributing to 401ks anymore. They're not putting money into retirement. So the real cost, and I've seen figures as high as 600,000, the average, there's 53 million American caregivers in this country right now that are unpaid. These are kids that are helping out mom and dad, and the cost to them is staggering. They don't, I had to quit coaching football, for example. I was coaching two of my son's football teams. I had a small, like a fourth grade league, and then I was also coaching the eighth graders. So I had to give up coaching. I had to basically to give up my family. I was over at my dad's 7 days a week. And so talk about all this stuff ahead of time. Your presentation should flush this out, but the first one is key there. Do your kids make your decisions, or you make decisions for you? Have you talked with them about you moving in with them, or are they moving in with you? That flushes it out right away. So the kids will take care of me objection should be an easy one to eliminate, or at least talk about with them and have them be honest. Okay, price. I don't know how you're ever going to get around price, but I'm going to try to give you a couple options here. First of all, when I'm designing a plan, there are a lot of options we can do here. Your Volkswagen or Cadillac, right? These plans can be designed whatever kind of budget your client may have. So, there's nothing wrong with pitching a smaller long-term care benefit. There's short-term care plans. There's home health care only plans. So, you have to use all the tools in your toolbox. I can't walk in there and pitch something that's $6,000 a year or $500 a month to most clients, right? I'm not going to get a check. But I mean, I from a mentor of mine, I remember Mark Randall used to say to me, ask your client if they can afford $20 a month. They're likely going to say yes. Ask your client if they can spend $600 a month. They're likely going to say no. Would you agree that you can afford something in between there? This is kind of the Volkswagen bug thing. Some coverage is better than nothing. Also, with price, this is just takes out of another, I've been teaching this for years, but know that we're not trying to use 5% compound anymore. Look at this example here. If you're not maybe pricing policies right, maybe price is an issue, maybe you got to spend a couple of minutes with myself or some of the directors and let us show you how to price these things where you're not scaring the clients. Notice here I'm using a policy maximum of $270,000 on all three examples. Okay, same policy maximum. I'm just doing a shorter, fatter, long, skinny. This is spread over 5 years, the 5% compound. And if you'll notice here, the annual premium is $11,000. My benefits now are $4,500, 10 years, 20 years, $1,196. Okay, this is a 60-year-old couple, so the claims happen around 80. So same policy maximum, $270,000. This time I'm going to use a $7,500 benefit and go 3% compound. Same 270. I did that premium, I'd lower it to 86. But I'm telling people to go even further. Now, either use 1% inflation or no inflation. Use the same $270,000. Put that benefit at 10 grand. With a premium now, 58. I've cut that premium in half. And the benefits in 20 years from now are equal to or greater than I was doing it the other way. So short and fat, we have to be smarter about how we price policies now to help you with price. Other things. So if you don't think this premium is affordable, a lot of my clients feel the same way. So what I used to say to my clients is, look, imagine if you can't afford $200 a month right now, if that's just going to be too hard to budget, too hard to figure out. Imagine suddenly needing care and being faced with budgeting $6,000 to $9,000 a month. Right? Long-term care could be more than that, 6, 7, 8,000 a month, 9,000 a month. So what's better? Can you budget $200 a month, or can you budget $7,000 a month? It's another thing your angle to kind of get them thinking about price. Okay. Post-presentation objections. So those first three, price, the kids, and insurability. And you'll notice in the survey, I'll kind of show you a glimpse at some of the surveys we got here, a spreadsheet. Those are three big ones. So those three should be kind of flushed out in any good presentation, or just make a preemptive move on those. Those shouldn't be holding you up. For sure, the health shouldn't be. Price, I can design a plan for a home health care only plan is, I don't know, $30 a month, $40, and with the prescription drug reimbursement and like GTL's home health care plan, if they're taking a couple prescriptions, we're getting that price down to $10 a month for a 1-year home health care plan. So price shouldn't be an issue. The other thing is just creating that need enough. The urgency, that's what a presentation will do for you, is create that need and create some urgency. And so we flush out the kids taking care of us, we flush out the price, we flush out the urgency of it, okay, and the health problems. So what are the other ones? I need to think about it. I don't know what to do about that one. I need to think about it. People are, they're just, so maybe you just, again, the presentation does better with the urgency. But as far as I need to think about it, what do you do with this one? Well, by going ahead today, we'll find out if you qualify for the coverage. We can lock in today's health. help protect against further insurability. You know, I would used to use this, call it my Easter close, call it my Thanksgiving close. But when I sat with people, say, I don't know, middle of October or something, or if it was after Thanksgiving, maybe it was, you know, the first week of December, or I would tell them, look, by going ahead today, we've locked your health. Now, I don't know if you slip on the ice tomorrow and break a hip, or I don't know, you have a stroke in the next 2 weeks. Maybe when the kids come over for Christmas, you can discuss this with them. You know, it's going to take a while to underwrite this thing. It's going to take, you know, 6 to 8 weeks to get it all done. And so, you know, by going ahead today, what we've done is we've locked in your health. Now let's have it here again. There it is. So, you know, even if I come back here 6 weeks from now and you decide maybe you didn't want to do this, you're covered while we're doing this underwriting. So, you know, it's actually, I'll take that back. Some companies now are doing they do like a temporary insurance agreement for you're good for X amount of days. But generally speaking, once you take that application, you've locked in that health. And so if anything, if they change your mind, if there's something happens to them, if they had that stroke, by taking an application today, you've locked in the health. Even if they decide to drop this years on the road or what have you, is you are locking that health. And that's so important. I can't tell you how many times people have a little issue with the doctor and now suddenly they're out. They have a mild stroke, a TIA, they slip, they fall, they have a, you know, a sore knee, they have to do physical therapy. So many things can knock people out that by starting the process sooner than later, you're locking in that health. And so, and I used to call this the decision time, you know, how to start the process is, you know, once I take this application from you, they're going to have to complete the insurance application. They're going to call you. They're going to do a health interview. They're going to ask, you know, who the current president is, you know, what day of the week it is, that kind of stuff, and kind of make them laugh a little bit. They're going to ask you some memory questions, and they're not worried about if you're losing the car or the car keys. They're worried about if you're losing the car type thing. And so I walk them through this, that this is not exactly an easy thing to get, but, you know, if we go forward now, you know, you don't have to decide on this right now. You have 6 or 8 weeks to kind of, I don't know, decide this, work through it. But I don't know what kind of rating you're going to get. I'm not sure that you'll qualify for this. You know, I think you'll qualify for this plan based on the presentation, et cetera, in my knowledge. So in case we want to change anything, redirect, go with a different one, you know, there's a lot more going on here than just saying yes. I'm not asking you to say yes or no right now. I'm just asking you to start the process. So I can kind of get people off the schneid, I guess, if you will, and get them moving forward. Okay. Plus, again, it's that safety valve. You'll have the 6 or 8 week period to kind of reaffirm that you made a sound decision. If something's truly bugging you when I get back, we'll talk about it. You know, you're going to have 30 days to decide on this after I get back and after we make an underwriting decision. So, you know, if there's something you decide you want to change the benefits, or maybe you want to look at a different plan, or so, you know, this gives you everyone a little time to see where, if you're accepted, to see where we're at. So that's how I kind of get people around I think about it. Also, last thing I'd say on this, I used to use this one. You know, when I'm sitting with a client and they want to think about it, I knew I'm not getting back on that house. We all know this, or I'm not probably getting that client back on. Sometimes in the online nature of it, they're like, you know, let's call tomorrow, let's do this again. Or I always kind of told people, look, when I spent the 45 minutes or an hour going through this with you, you know, you have access to 100% of the information right now. Tomorrow at this point, human nature, you'll have forgotten 50% of this. And by the next day, 2 days from now, you'll have forgotten 75%. It says you'll forget here. Actually, this is supposed to be, I apologize, that's supposed to be a 75 there. So essentially, you're trying to make a decision on 25% of the information 2 days from now. The best time to make a decision is right now, while you have 100% of the information in front of you. So this, and I'll call you in a couple of days if I decide to apply. I know from experience that won't start. And so, and I used to tell people, you know, can you call me next week? Can you maybe check with me? Frankly, I just say, you know what, I don't have time to go backwards and try to resell people again. I've just done everything I can. We've looked at that. We've looked at all the facts here. If you're ready to apply, kindly just give me a call when you're ready. You know, I don't know what else I can't be saying. There's not much more I can say at this point. If you don't want to start the process today, that's why, again, starting the process is just getting an application. So I would kind of use some of that too, saying I'm too busy of a person. I can't come back and re-ask and re-ask and re-ask. I've done the presentation, so I don't like to call people back. If you're ready to go forward, just let me know. I'm happy to take your application and we can come back, we can revisit this. So almost like a takeaway. Okay. Other than that, there's sometimes agents, you can ask your client, Why are we not going forward? What do you think about? I mean, do you think you need this product? Do you like the product? Can you afford the product? The answers are yes to all of them. Then it's time to move forward type thing. Okay. What if I die in my sleep and never use this insurance, otherwise known as the dreaded use it or lose it? Right at the top, what I would tell people on this one is, look, do you ever think about this about your car insurance, your homeowner's insurance, your dental insurance? You pay those premiums, you never think twice about it. You know, when's the last time you've been in a car accident? 8 years ago, 9 years ago? Maybe when your kids were young and the daughter backed over something and, your son, dinged the car up, or, most people pay those premiums and don't think anything about the fact they never use it. Doesn't bother them at all. Same with homeowners. They pay that, it comes right out of their mortgage, or it's part of their mortgage. They don't even think about the homeowner's insurance. These premiums are paid without a second thought. But then look at again, this is a major risk. The odds of you having your home burned down or blow down in a tornado, 1 in 1,200. Look at that. So that one little red dot there is your shot that you're going to need that home insurance. Yet you pay that premium and don't even think about it. That's no big deal. The odds of you being in a totaled your car accident where it's totaled your car, 5 in 1,200. Those dots, right? Such a small, incredibly small percentage of a chance there. Chance of being hospitalized. Now, these are for hospitalizations that are cost you more than 10 grand out of pocket, right? This is like a heart attack or a stroke, right? Basically, one out of 10, 105 out of 1,200. Okay. Well, your chance of needing long-term care, right? By far, the most likely thing that's going to happen to someone is long-term care. And by the way, it takes your car, your home, your retirement funds, it takes everything. So when you get a car accident, you don't lose your house too, right? Your house burns down, you don't lose your car. But when you need long-term care, you lose everything. Yet, and it's by so far the most likely thing coming right down that road for these people. It's going to hit them right head on and wipe them out. And yet so many of them don't have that insured. So, again, I as far as what if I never need this, or I die in my sleep and never need it, there is something about protecting your assets. There's a value in that, okay? Now, the other thing, the industry standard has become, the reason why people aren't buying long-term care, I'm gonna try to not go on my soapbox too long here. Use it or lose it. I do an entire presentation, I'm not gonna go into right now, about how the hybrid isn't necessarily the best way to go about that. A lot of people are buying these expensive hybrids that give them a life insurance or a long-term care benefit. In reality, if you buy traditional long-term care and buy just a standalone life product, you're usually about half the premium. You get both benefits guaranteed. So with a hybrid, it's use it and lose it. If you use the darn thing, you don't get your life benefit or vice versa. So it's not necessarily the best way to go about it. Rate stability. People are nervous about these rates going up. The fact of the matter is, with today's pricing, and yes, 20 years ago, the things were badly priced. They had bad rate increases. The Society of Actuaries pricing now, with lapse rates now being set lower than 1%, morbidity thing, they use all different numbers. The long-term care interest rates as countries went in the tank. Long-term care companies are very dependent on having that money invested for 30 years. The average policy stays in place for 28 years. So it does take long. So they are very susceptible to that. So now that you have low interest rate environment, they know how many people lapse them. The companies are a lot better pricing them. So much so that the Society of Actuaries here that do studies on this, the chance of the policies that were written 2014 and beyond have a less than 10% chance of going up. And that's the numbers here for the newer one is closer to 5%. So they're very unlikely to go up. If you want to read more about price stability, if you want to make your clients feel better, there's an article here. It's called Too Legit to Quit in Brokers World Magazine, March 2017. Outstanding stuff. In other words, we have a lot more actuarial data to go on. We have a lot more claims history. We're using extremely conservative interest rate environment. They have the claim experience, the lapse ratios. There wasn't any information on this 25 years ago when a lot of these policies were being written, and some of those have had some pretty bad rate increases. So the rates are pretty stable now. Another objection. I know we're already 35 after the hour here. We got about 5 more minutes. I'll try to wrap these things up here. Should I wait till I'm older? Well, here's a problem with waiting. The cost of waiting can be big, huge. And I do understand the common thought is, I'm gonna wait till I'm older. You know, this just seems like an old person's thing that, you know, I don't really need when I'm in my mid 50s. Why would I need long-term care? And the answer is simple. It's insurability. You know, long-term care plans, because of some of the claims, because of some of the problems they've had, the companies are underwriting these policies a lot more. Matter of fact, 10 years ago, there was 100 companies offering long-term care insurance policies to the public. We're down to as little as 4 or 5 now. Now, why would 95 companies get out of the industry? Typically, insurance companies don't leave industries they're making money on. The reason they got out is because they weren't making money, right? Because people use these policies. So this insurability, the companies that have stayed in it, they do insure them, or they underwrite them a lot tougher than they did 10 years ago because they know better. They've gotten their nose bloodied enough. So there is a huge insurability factor here. So when people say I'm going to wait a couple of years, can't tell you how damaging that can be, because they're going to take themselves out of the game. They had that mild stroke, or they had that knee replacement, and there's complications or what have you, valve issue, or you know, they develop sleep apnea. Who would have known that would have kept people out? Wasn't even around 15 years ago, and I was taking a lot of apps in the field. Now sleep apnea knocks you out. So insurability is becoming tough. So the longer you wait, your insurability becomes a real issue. That's the biggest reason you don't wait. I always tell people, you buy this insurance with your checkbook, not with your health. Excuse me. You buy it with your health, not with your checkbook. All right. So when you're healthy, you have the best chance of getting coverage and obtaining that coverage. But anyways, what's another true cost of waiting? The longer you wait, the more you pay in premiums. So this is a 55-year-old couple. The benefits here we're talking about is $4K monthly, $100K policy max, 3% compound. Okay. So that combined premium is $35.18 when they're 55. If they paid that all the way to 85, again, average claims are at 80 to 85. So let's just say they paid these to insure themselves to age 85, they will have spent $105,000. And by the way, the break even on that, 129 days, 198 days for the female to break even. So in other words, 4 months of care, they get all 30 years of premiums back. 4 months of care, which is pretty common. For a married couple, 90% of married couples are going to require care. This married couple is likely getting their money back, if not more. Okay. Same couple, by the way, they waited till 65 to buy the same benefits. Their combined premium now is $68.61. If they paid themselves to 85, they're going to spend $137,000 as opposed to $105,000. The longer you wait, the more it costs you. And their break even now he needs 168 days of care to break even. She needs 255. So again, the longer you wait to buy coverage, the more it costs you. Now there's a third cost of waiting. It's a little more sneaky one. The policies that were written back, I don't know, 2007, 2014, they keep getting higher because they just didn't price it right. And so sometimes when people say, I'm going to wait for a couple of years, well, if the carrier, let's say you're going with Mutual Omaha. Mutual Omaha is going to lock off their 2013 block or their 2020 block. When they come out with a new policy series, it's higher. Mutual just came out with a new one. They repriced everything here about 18 months ago. The prices went up in some areas, right? They're more reluctant to raise rates on older blocks now because they've had so much of that the industry took a black eye. And some of those older blocks may continue to have rate increases, but the newer ones written in the last, I don't know, 5-10 years, a lot more stable, but they're priced higher. So what people kind of don't factor is if their health stays good, and yes, as they get older, they're going to pay more overall, but they couldn't afford it right now. The other thing that happens is the new models come out and they're new expensive. So the new models are more expensive. Your health can get worse, and the sooner you buy it, it's cheaper. So there's no benefit to waiting. Should I invest the difference? This is a whole topic here. Let me just summarize this one. It doesn't work. People say, what if I take this $2,000 that I'm going to spend on long-term care, and if I invest it at 3, 4, 5%, You know, in 20 years, I'm going to have $160,000. In 20 years, the average nursing home is going to cost $12,000 a month, so it's going to last you less than a year, 9 months. Where had you put the $4,000 or $3,000 or $2,000 a month into a long-term care policy and bought a pot of money of $250,000, growing at 3%, you now have a $500,000 of benefit versus $100,000 benefit. So the only way to try to invest the difference, unless you're getting 40% return or you're willing to invest $30,000 a year, it just doesn't work out. You're better to shift that to the insurance company. So let me kind of bypass all that then. The last one, the government will take care of me. This is the last one I got here, folks. So again, I know it's 2:40. So this one can go a lot of ways. And you know what? I have a government spend down here. In other words, let's assume that we're going to go broke. We're going to transfer our assets, hide them, whatever, impoverish ourselves. In this example, this is something you can get from GoldenCare. It's our Medicaid spend down calculator. It more or less just shows kind of the flaw, the saying, let's let Medicaid take care of me, what you're allowed to keep. You know, a family that has, again, home and other assets of $350,000, husband's income, wife's income, total money. Okay, you go through all this. At the end of the day, they lose a lot of this money. They're going to lose half of their estate. And again, I have this spend down calculator. If you ever want to pump a husband and wife in here and kind of look at what the Medicaid real rules are, how they get spent down, how exactly that works, you end up leaving the wife with an income of like $89. She only gets so much money. And even if you can, at the end of the day, let me go to my next one too here. The other thing is people try to give away their assets. They try to, I don't know, impoverish themselves to go on Medicaid. In other words, here's how I handle, the government will take care of me. Medicaid's out there. If you know anything about Medicaid, Medicare right now, those budgets are in big, big trouble. The unfunded liability that props up, you know, the Medicare, Medicaid, Social Security are, you know, the different, depending on what projections you look at. So when I tell people you're relying on a government that is so overwhelmed right now, the baby boomers, you know, when Medicare was written, there was 11.5 people working, paying into that system for every one recipient. Now we're down to 2 workers for every 1 recipient. No one wants to work in this country anymore, but the demographics are getting older. There's just not enough money going into the system to handle the tidal wave of care that's coming. So that money is running out. So one thing they've done, if you don't know about the Deficit Reduction Act of 2005, they don't allow you to transfer assets in your kids' names anymore. You know, 3-year lookbacks, 5-year lookbacks. The Deficit Reduction Act was sweeping legislation that said, look, if you try to give away all your assets, we can hold you out or make you exempt or ineligible for Medicaid for however many years that asset transfer. If you gave away $500,000, let's just say the average cost is $50,000 a year, you're ineligible for Medicaid for 10 years. So the deficit, and it's retroactive. It doesn't matter if you transferred your stuff 3 years ago, 5 years ago, 7 years ago, 12 years ago, 20 years ago. And so, but you'll still hear people out there, clients, customers will say, yeah, well, my lawyer said there's still ways to hide the assets. I can get away from Medicaid. There's such a way that I can do this that Medicaid won't know. Well, one of the ways you can do that is there's something called an irrevocable burial trust. The problem with that is you put like 10 grand in there. I did this with my father. Any unused amounts, the state is a beneficiary. That's how the irrevocable works. So before my dad got spent down, you know, I moved at least like 8,000 or 9,000 into this irrevocable trust. So I made sure I had money for his burial. And then basically the state got the rest. Well, this Deficit Reduction Act more or less doesn't let people transfer their assets anymore. And even if you could, I always tell people a couple things, my clients, ask your financial planner or ask your lawyer who's doing this, like, I don't know, he's setting up some Medicaid annuity or some clever way of hiding. Just ask him, if I end up in a nursing home and get spent down, are you telling that my assets are gonna be protected? And have them just sign, yeah, they'll be fine. Have them sign a document saying that, you know, we've put these assets in such and such an account, therefore they're exempt to Medicaid. Have them sign that, put your file, that way you're safe. There's not a single financial planner or lawyer that will do that because they know it's illegal and they know it's wrong, okay? And so the other thing I tell people is this, as far as relying on the government for your care, because I still hear people say, you know, my aunt and uncle, you know, they needed help, they gave their money away, they did that. They went to the state took care of them, like, you know, 7 years ago, 5 years ago, 4. Here's what's happening. The states are running out of money. So this all came down to like at the local level, whatever county it was, whatever state, The workers that are looking at these transfers, are they going through your transfers with a fine-tooth comb, or if they had plenty of money, they didn't care? They just kind of approved things. As money is running out and things are stretched thinner, they are looking more and more at these transfers. So this Deficit Reduction Act, it doesn't necessarily always get used right now, but as the money runs out, it's going to start getting tougher and tougher to do this. And here's the last thing I'll say on this. If you went and looked at today's Medicaid nursing homes, they're not great now. Imagine when this country goes broke, what the Medicaid level is going to be at. So when I tell these kind of clever people that say, I've hidden my assets, I hid $500,000, and they're very proud of themselves, right? They're clever. They've got a lawyer or some financial planner that's hidden their money in an offshore account, and you know, they look at you like they've outsmarted her. So that means you're purposely setting yourself up for Medicaid. So you've got $1 million somewhere, yet you're gonna then qualify for Medicaid and be in some awful level of care. So you know, you're gonna pay for this care one way or the other. If you have the money, then why not protect yourself and get the quality care that you want? Because at the end of the day, you know, it becomes quality of care. Okay, so I have kind of that, and I want to just do one last thing with you folks today, and just kind of address some of the responses we got. I don't want to share the names per se here, so bear with me. Maybe you guys can see that. Okay, without the names. If you'll notice, the ones in purple here are the ones I talked about. Too expensive, too hard to qualify for, too many rate increases. A couple of the ones that were interesting. A lack of trust to the industry. You know, the publicity, the level of protection, the stringent application requirements, the flexibility plans. There's no uniform system of standards, lack of professional. What I'm hearing more of, it's kind of interesting from folks, is they don't trust the industry itself. Like they don't trust the nursing homes. Like who knows if these nursing homes are going to be able to accept these plans, or are they going to be able to, you know, handle the needs? So I'm not sure how to go about that. I guess, you know, having the money to pay for, because I got to imagine all these facilities out there, there'll be some you want to go to and some you don't. There's domiciliary care homes now. There's congregate care facilities, assisted living facilities. Most people would rather go to assisted living than, you know, a Medicaid nursing home. So out of all these facilities that are out there, they're still going to be regulated by the government. And so I still would think with long-term care, you're going to want to have the options, I guess, to pick from them. That's one of the things that the long-term care does, is give you choices. The one here, I'll talk with my financial planner. That's a common objection you do here. I need to talk to my financial planner. Nothing worse than that one, because this financial planner is the guy that's never brought this up to him. Maybe he's one of these slick financial planners that's going to hide their assets and put them in a bad spot down the road. Or you talk your client to buying long-term care, he goes to his financial planner, and your financial planner sells him a plan. Oh, I've always said, the same guy who basically didn't tell you about this for 10 years is now going to sell you a plan because I created the need. I don't know what to do there. There's not much you can. Sometimes I tell people that financial planners are financial planners. I'm a long-term care specialist. You know, see what he has to offer you, but I work with all the carriers, all the plans, not just, you know, particular one carrier. So stringent application requirements, yeah, that's part of what long-term care is. I know that's one of the objections that people hear. But you do want the company you're buying from to have some strict underwriting. You can't just issue policies anymore. Otherwise, you've got your current policyholders to protect from rate increases. So I can't see that getting better. And if that's an objection, just walk them through how important good underwriting is. And really do the takeaway. I always tell my clients, you know, if you can qualify for this coverage, you'll get this. And if you can qualify, they'll give you home care. They'll give you, you know, and then if I finally get to ask me, what do you mean, can I qualify? Well, it's kind of hard to get. You know, you got to put an application in, so I did like to, I don't know, I guess, kind of the takeaway, got to the point where like, well, I want to qualify. Like, how do we find out? Well, we got to start the process, take the application. Okay, last thing I want to talk about here quickly. Two of the things that I thought were pretty good. These came from, I'll call this Mark in California, and again, Ray from Ohio. And same thing here. You know, when you get an objection, it says, and I thought this is good, ask the client to repeat the objection, because sometimes the second time they go through that, you may get more of their real objection out to the surface. In other words, they go, well, you know, well, tell me more about that. Well, here's what, to be honest, So when you ask someone a second time, you might get the truer objection there. I love that tip. Thank you, Mark. Another one, this is, be a field underwriter. Instead of being an agent that's selling them something, like I mentioned in my pivot presentation to start this thing, be very good about asking the questions because you're trying to help them solve this problem. You're a field underwriter. You're not an agent. You're not a salesperson. You're simply trying to talk about their health, assets, and things to try to kind of crack this mystery for them. You're a field underwriter. You're an interviewer. You're not a sales guy. So I kind of like that because that's what it comes down to is half the people you talk to aren't going to qualify or can't buy anything. I like to get that out of the bag right away. Like there's a lot of we have to go through some pre-qualifications. Now, granted, if you use the pivot presentation, I'm going to end up with an app about 90% of the time. There's very rare that someone's not going to qualify for something. So with that, I'm going to kind of wrap this up. So folks, I want to thank you guys for coming on board. Hopefully this was helpful to some of you. I know I got a little bit longer than I wanted to. A lot to cover here. It's a big topic. So if there are other objections that you're running to that weren't covered here, give us a call at the marketing office. We'll give you some stuff, maybe help you with some materials. We maybe have a couple slides or a PDF that can help you with a common objection you're running into. If there's a constant barrier that's keeping you from running long-term care, maybe it's what's keeping you from running it. Maybe it's your lack of understanding. Maybe you're a little bit, you don't feel, people don't just sell things they're not confident about. So if you need us to help you with some product knowledge or this pivot presentation I'm talking about or the missing link, if you want to see copies of any of this stuff that we can help you with, give us a call. Marketing materials, I need more people to see all this kind of stuff. If it's mailers, brochures, or things we can help you get in front of more people, let us know how we can help. But I want to thank you for coming on board, and I'm going to put our 800 number on here if it's not on here. 800-842-7799 is our phone number. So again, folks, I want to thank you for coming on board. If there are some objections that are bugging you still, give us a call. We'll walk you through them. So with that, thanks a lot for coming on board. Give us a call if you need us, 800-842-7799, and good luck selling out there.
Check out our website, GoldenCareAgent.com, or give us a call at 800-842-7799.